I'm just overwhelmed at how much work this has got to have been for your company and your team. And it was just been really great participants and great companies. And I'm just really appreciative. It's been very, very fun to be involved. So thanks for doing all that.
Thanks, Janice.
Yeah, yeah, it was really impressive. So I'm Janice Orlando. And like Jay said, that I am involved with angel investing for a long time. I've been an entrepreneur and scaled companies and been involved with operations and all kinds of fun things in the past. And I am really enjoying a new company that we're involved with that is looking at and dealing with the R&D tax credit. So that's why I'm here and speaking to this today. So I have a couple of my team members in the room. So if we have some high expertise questions, we'll get answers for you, hopefully. That'll be our plan. So anyway, topics we're going to cover today. What's the R&D credit? What's changed to make it accessible? What are the benefits, both short and long term? Why is the opportunity of this free money so obscure? Everybody asks the question, why doesn't anybody know about this? It's a little random, right? We're going to look at who's eligible. There's an IRS criteria that's called a 4-part test. So we're going to do an overview of that, a general view of what that means and how you qualify. And then we're going to talk about the process of actually capturing and utilizing credits. And then I want to end with some minimum expectations if you actually have somebody work with you on a tax credit report, and then some great to haves if in that same conversation. So that's where we're going. So feel free and put questions in the chat if you have questions along the way, and hopefully we'll get some of them answered for you. So what is the R&D tax credit? It's a dollar for dollar, non-dilutive cash incentive. And it's for US based companies who innovate. It's pretty much what it is. It's very straightforward. And a little bit of tax history. So I want to actually give you a big picture of what's happened and not bore you too much with the history. But in 1981, the US tax credit legislation was passed, and it was like I said, developed to incentivize US companies to innovate. And so interesting, over the next 30 years, a fun fact is that close to 90% of the credits that were utilized were companies with over 100 million in revenue. So there was an interim piece that was enacted in 2006 that actually added some flexibility to the calculating the credits and changing baseline calculations, which is called the ASC method. And it's just a way of working with the credits that's a little more user-friendly and flexible for companies. And then fast forward 30 plus years, and the PATH Act was passed. And that's why this is a relevant conversation to most of you today, because it specifically created a way for small and medium-sized businesses to participate in this really cool credit that the federal government was promoting. So what it did, and the PATH Act, probably one of those important pieces to it is it became permanent, and it was bipartisan support. And so we don't have any questions about whether or not it'll be turned over in the new group of people in Washington every few years. And so it's very cool in that way that you can do actually planning with your company around this tax benefit. So just some notes. In 2016, after the PATH Act was passed, there was 16 billion of R&D tax credits that were accessed. And it's a common belief now that by 2025, that over 30 billion will be utilized annually. So this is currently actually an opportunity of a $50 billion annual resource. So the numbers are huge. And so what we think is that, just as a big picture, 50 billion available. It was estimated in 2018 that only 13.5 billion was claimed. And so that left 36.5 billion unclaimed as of then. So what is the PATH Act? So besides for what I just mentioned in terms of big benefit of being a permanent tax planning opportunity, the legislation actually created a compliance formula for how to be qualified as a startup company. So startup compliance looks like, this is really simplified what I'm giving you. There's a lot of overlays to this, but basically in the event if you didn't have gross receipts 5 years prior to the claim year, then you would be considered a startup. So in English, if we were looking at 2020 expenses, and you're thinking about tax planning and capturing credits for this year as you do your planning into filing, if in 2015 or 16 you started having gross receipts, then this will be your last year of actually being qualified. So there's these years kind of, and that's a general statement because it depends on when you filed and when the taxes were due, and there's lots of date variables in there, but that's a general statement. So, and then the other piece is that gross receipts of less than 5 million in the claim year. That's another requirement. You have to have less than gross receipts in that claim year. The other thing that the PATH Act did was actually create a alternate offset for the AMT liability. So these are for companies, S and C corps that are planning and a way to actually utilize the credits along with the AMT. So those are for companies less than 50 million in average revenue over the last 3 years. So that's a general statement there. So now what are the benefits of the R&D tax credit? So as a startup, what's very cool is that if you're pre-revenue or no revenue or less than 5 million in a claim year, you could actually maximize up to $1,250,000 in 5 years in payroll tax offsets. And that would look like up to $250,000 per year. So it's a huge cash benefit if you were in the position to use that much. So technically, the way it works is that after you filed, you claim the credits, you can start offsetting your payroll taxes the quarter after you file. And so that's a big incentive to get started on it. If it's something that you think that you can utilize, it's awesome. So the good news also is if you capture credits that maybe you don't have payroll tax offsets to use, your credits don't go away. They get placed on your balance sheet as a carry forward. So it's not like they go away, and you can carry forward for up to 20 years. So it's a great benefit that way too. So in the startup world, those are some basic benefits. And in profitable companies, it's a direct dollar for dollar offset for your, and it's unlimited on your tax liability. So if you owe money to the IRS at the end of the year and you have R&D tax credits, so it's $1 for dollar offset. So it's pretty cool. And then another benefit is that you can retroactively claim past credits. And so that's very interesting. You can do that both for the federal and the state, depending on the state that you're in. So there's some benefits there. And again, you can carry forward credits up to 20 years. So it has a long life and shelf life in terms of value. So what's the problem? Why is this money so obscure? Everybody wants to know, why don't we know about this? Why didn't we know about it? We talk to companies all the time that say, why didn't I know about this? Well, several things. Awareness. Most small CPA, either just tax people or CPAs or individuals actually don't know about the credits. It's very common that it isn't even something that people know about. And if they know about it and they're a mid-level company and they know that there is an R&D tax credit, the complexities of it are really overwhelming and very labor intensive. And it's complicated to know how to claim the credits. So the risk and the complexity becomes a barrier. And then you move into the rates. Traditionally, all these 30, 40, almost 40 years now of being able to access it, for decades, it was all rolled out by the big four firms, and it was very costly, very expensive. And so it's really obvious why the companies with over 100 million in revenue were able to afford it, because just doing the study alone was anywhere from $30,000 to $100,000 just for the study without actually, claiming the credits. And so it was very costly. So what is the solution? Well, the solution is like what we're all pretty much in the business of right now, is creating software and automation and solving problems. So that's the really exciting part about what's happening right now. It's getting a lot of visibility because we're actually able to automate the process of this. So from the awareness point of view, the with cross marketing events just like this, conversations like this with startups, affiliates, partner networks, people are learning about the credit. So that's awesome. And then the risk and complexity piece is actually being managed now better with data science. And so we're able to do calculations, be able to optimize, we're able to maximize credits, look at people's expenses, be smarter and faster, and just putting data together in a way that's manageable. So the automation is taking out a lot of the risk and the complexity of it. So that's in process for a lot of companies, which is really cool. And then the last piece that's really manageable for the small and medium-sized companies is that because the fees are becoming much more transparent. So there's still a lot of companies that charge by hourly and by retainer, and that's happening a lot still. But also what's happening in the industry is that people are actually charging by a percentage of utilized credits, or they're by identified credits. So those are the kinds of rates that we see and fees that we see, which are way more manageable than they have been in the past. So the good news is that the R&D tax credit is in process of becoming democratized. So it's one of our favorite conversations to have, because it's available to a lot more people in a lot different economic positions. So next question, how do you qualify for R&D tax credits? So these are 4 basic questions, and we'll go a little deeper into it with the 4-part test. So do you develop new or improved products or processes? Do you reduce uncertainty through innovation? Do you use hard science like engineering, biological, or computer science? And do you test multiple variables? So what does that really mean? Let's just do a little deeper dive. This is the 4-part test that the IRS has written for their compliance. So we have uncertainty, we have technology, experimentation, and purpose. So looking a little closer at that. So eliminating uncertainty looks like developing, improving a product, process, technique, or formula. So that's really the bottom line of that. So are you doing something that's technically has uncertainties? Are you trying to eliminate uncertainties? And so I can tell you that these 4-part tests, pretty much everybody listening to this call is involved with companies that are compliant to this. It's very, very common. The technology world is the perfect place to take advantage of the R&D credits. Again, technology and nature. So are you doing business? Are you discovering information that's technological, physical science, biological science, computer science, or engineering? And so that's speaks for itself. The soft sciences don't really apply, such as economics, psychology, or management. They could if they were dealing in analytics or some sort of technology in that field, but not necessarily. Process of experimentation. So does the activity involve evaluation of alternatives, hypothesis? Are you defining and discovering and discarding? And then a big piece is actually cost. So if you are funded with no risk for cost overruns or risk to the company, you may not qualify for the R&D tax credit. So it's when substantially all the activities are part of experimentation and there isn't certainty in the outcomes, that's what the IRS likes to see. And then the permitted purpose. So does the activity needs to be new or improved? So is it about function, performance, reliability, or quality? So if you are inventing something, if you have patents, any sort of techniques, formulas, analytics you're developing, anything that's creating new or improved in these areas could qualify. So excluded activities, we always talk about what's included, and then people wonder. There's a long list, but and the ones that come up most frequently in the startup world are areas that like marketing. Most marketing does not qualify. I think there's exceptions to that depending on what is happening in the people are building marketplace or building analytics, or they can qualify for the 4-part test, obviously. But in the event they're just or like specializing in advertising promotions, a lot of SEO does not qualify. So companies do both. So part of the process of capturing the credit is identifying what parts of the company actually do qualify and which parts maybe are not part of the activities that are qualified. So sometimes companies are utilizing other people's existing products, software, and they're maximizing it. They're using it on behalf of another company. And so if it is not your own and you're not really customizing it, then it wouldn't really qualify. So, and then another real important piece is the foreign research. So in the event you're doing your R&D outside the United States, that part of the activity would not qualify as well. We have companies that have people who work sometimes here and sometimes in another country. And so we would separate out that time, and that happens a lot in the development world, of course. So what are qualified R&D expenses? So there's basically 2 areas of this. One is in wages, and that's really simple, the percentage of time spent by US employees. So there's 3 areas where you qualify. One is, are you actually performing the R&D? Are you directly supervising the R&D? Are you directly supporting R&D? So most of our startups, the entrepreneurs are doing a lot of the work in R&D, and their developers are doing most of it. And so there's high qualification in this area. So this is wages. This is your payroll section. And then we hear questions like, well, what happens when we're mostly paying 1099 employees? Well, then that's when you would move into your expenses. So, and part of this upload of your QuickBooks or whatever you're identifying your expenses in is how you spend your money. So that could be prototypes, supplies, and then this is where your 1099 US consultants come in. And in the event they are part of your direct cost structure, but not necessarily employees, they would also qualify. So sometimes you see in the industry that people will only qualify the payroll section, but what we see is when we do both, that the numbers become much larger, and a lot of times, especially in the startup world. So what's the optimal process? We have a little bit of a cartoon here happening, but it's pretty visual because it's not that complicated. Sometimes it sounds like it is. So the first one is the data dive. So this is the part that gets in the beginning that actually goes into the process of creating 2 sections of the output. One is quantitative and one is qualitative. So in the quantitative area, there's basically 4 pieces of data that someone will need to actually do the credit analysis and come up with a calculation on how much credit you could capture. Your payroll records, your expense reports, your previous tax returns, and an org chart. It's pretty simple to get to a quantitative number. And then from there, the qualitative piece, which is actually required by the IRS to be defensible, is your supporting documents. So you would supply also contemporaneous documents that would include things like these examples: tech specs, testing reports, presentations, patent applications, pitch decks, Jira, GitHub, analytical reports, dev epics. There's all kinds of things that actually get rolled up into documentation that support and become your defense to the IRS. In the event you were ever audited, you'd have these support documents, and as part of a report that your R&D tax credit company will supply to you. So it's the quantitative, which is the number, And then this qualitative backs up what actually you get as a credit. These names at the bottom are just like the data dive. So you look into whatever you're using as a support for your all of your data in their company. Second step is actually then the calculation and compliance report. So the things you need to consider here is once you've done the dive, you get this feedback from what your credit could be. Then you start considering the compliance. You make sure that what you supplied is sufficient enough that you feel like you've gotten a good number from your support team. You want to look at your federal credits, of course, and then your state. So there's about I think 37 or 38 states that actually mirror in some ways the R&D tax credit. And so that's huge. In the state of California, it's almost a 1-for-1, whatever not always, but often, whatever the federal credit is, you can get the same amount. It's like a double, credit for the state. So the state's a little bit different. So the PATH Act does not flow through to the states. So it doesn't affect if you're a pre-revenue company and not in profit yet, your state credits would not be available to you for utilization yet, but they will flow forward so that when you do become profitable and you have tax liabilities to the state, you can offset your state liabilities. So it's very cool to collect them at the same time because they actually do expire over time to be able to capture them. So, and they roll forward just like the federal do. So that's what's really cool about that. You just want to look at your payroll, make sure it's been optimized, your expenses optimized. You want to be able to capture credits from the past. And there's just a few years you can go back in time. It's about 3 years for the federal and about 4 years for the state. And there's variables in that depending on when you're filing and what time of the year it is. And so you want to be able to capture past credits. We find that most companies, once we come in and do the initial year, that the past years are really relevant, and you can sometimes get, oftentimes if you're in profit, checks back from the government. So it's very cool in terms of cash flow. You want to consider making sure you get the qualitative reports because that's your backup for long-term compliance. And as you grow as a company, a lot of companies are doing multi-projects. And so the overlay of the credit would flow with different studies, with different projects. And so you want to make sure that if you're in that state and you're a large company or large project company, that you have an ability to track your credits by project, because the IRS does require that as well. And then progress tracking. So if you are a startup company and you're utilizing credits on a quarterly or monthly or whatever kind of basis that you're paying your payroll taxes, you want to be able to, track that, how much you're using and how much you have left. So you are in making sure that you're capturing everything that you can as you go. So now you know what you need, what you've gotten, you've got your reports. Now you need to capture it. So what a company will provide for you are tax forms. They're like a 1 or 2 page form that actually just gets submitted with your CPA's filing and or amending for past years. They're not complicated forms. That's what your R&D credit company will do for you. And then what's really important is, even in the space of automation and data collecting, what we want to make sure is that there's a white glove CPA at this point, until we get into some really sophisticated AI, that there's a really solid credit review by experts in the field, which is really a key piece. And then tax filing assistance. A lot of CPAs, big, small, all kinds of firms, are not accustomed to doing it. So it's nice to be able to have, it's really important actually, because we have times we provided the forms and then the CPA didn't quite know how to put it all together, and then they got filed without the R&D tax credit. So want to make sure that that flows through well, that there's a lot of communication and collaboration with the tax filing process. And then once you have the credits, there's a whole system that is where you have to upload those credits to your payroll provider in order to offset them. And so it's not complicated, it's just a process. And you need somebody usually, driving that train for you so that you don't miss those opportunities as they come along. So I think I've already spoken to this. In the event that all the credits aren't utilized in the year received, they can carry forward up to 20 years, and in most cases can be recorded as a deferred asset on a company balance sheet. So this is a nice piece for startup companies as well. It could be an asset in terms of some sort of an event. It's not a bad thing to have on your balance sheet. So let's see. Okay, so this is kind of the end. I want to talk about minimum expectations you should have from a credit study, and then what's great to have, what minimally you should be expecting, and then what is also very cool if you get it. Of course, the compliance, the 4-part test compliance. You want to make sure that whatever credits you are taking that are compliant to the 4-part test. And then I guess it's obvious, but bank level encryption for any data that you might upload to somebody to do these calculations for you is verifying that you have security and privacy with your data. Payroll and expense credit optimization. I talked to that earlier, just making sure you're getting really the best bang for your buck there. And transparent fees. It should be really clear to you now the way the industry is going and what your fees will be and when they would be due. Utilizing the federal and the state credits. If the state actually gives the credits, it's a big piece to actually capture that as well. You want to make sure you have your quantitative and qualitative reports. Tax filing assistance is really key with a lot of CPA collaboration. That's really makes things go smoothly for the entrepreneur. Your audit defense support. So a lot of companies, you want to make sure that at some level, if you ever were to get audited, that there would be defense, there would be support, that you'd have the documentation to go into an audit with confidence. So, and I mentioned earlier the multi-project studies. That's great as you scale, or if you're already at that place that you can actually process all those R&D credits appropriately. And the ability to capture credits from the past. A lot of companies are not doing that. They're just doing the present year, but it's kind of a lost piece because you do miss past opportunities just by amending and capturing credits. So if that makes sense to you, you can do it. Some companies don't want to and some do. It's an opportunity. And then, of course, the industry expert review. That's really a key piece in terms of what you would expect prior to filing with the IRS. It's a huge piece. So great to have. On the other side, if you can get a central document repository so you can access your documents when you need them, and in the future, you know what you've submitted, you know who submitted them at what time, you can have access to that. That's a very cool feature. Your payroll credit management. Again, that can be a little complex if you're in the payroll business, either monthly or quarterly. Some payroll companies will do that for you, which is very awesome. And most don't, however. So it ends up coming back to the company that's helping you with the R&D taxes and or your finance team to manage that. Progress tracking. So annually, where you are, what's going on, whether you're in a liability or payroll offset position, just managing the tracking. Dashboards, that what we're finding is in the automation process, we're ended up with really cool dashboards that can interface and ease everybody and manage the tracking well. Integrations on the backside so that the uploading is not a intense process for the company to upload in different formats and give to the companies for the data. One of the things that companies do sometimes is do a financial team strategy. Once the quantitative piece is established, once we know the value of the credit, is like then get the financial team together, the CPA, the CFO, whoever the entrepreneur, whoever's making decisions, and make a strategy. How are you going to utilize it? What does it look like? How does it roll out into the next year? And actually have a strategy session after you in the middle before you claim those credits. And then a big piece is great to have is no risk fees based on credit utilization. That is out there. So that's a big plus in today's market with early stage companies, especially in the COVID world right now. A lot of them are really affected with this. So it's a big value add. And then just the utilization of software along with the expertise of people in the industry is huge, and it gives a lot of creates more simplicity and confidence in your compliance process. So there you go. Do you have questions?
There are a lot of questions in the Q&A section if you want to
All right, great.
So there's 6 questions, it looks like.
Okay, so I should be able to get them from here, right?
No, no, it's in the Zoom part of it. If you hover over the Zoom, then you should see the Q&A. The Zoom window. I can read them for you if you want.
Okay.
So, or maybe Jay, can you see them?
I can see them. I was going to address a few of these here.
Yeah,
Great.
please go ahead. Yeah, go ahead, Jay.
Okay. First question here is, aren't payroll taxes small for startup companies? You know, it usually depends on the startup company. We are seeing some of them who put people on payroll right away, and we're seeing others who, of course, have everybody be a contractor. One thing that this payroll offset does, and we've already experienced this with one company where we said, hey, why don't you just put people on payroll? You've got these credits you can use to offset the payroll tax. You're in a better position to just put people on payroll now, and so they go ahead and do it. So it's really company specific as to whether they have a lot of payroll tax liability or not, depending on whether they're set up as contractors or whatnot. Next tax amount is like 13% of payroll. It's basically payroll to tax, and it's so it's basically the employer portion of the payroll tax. Obviously not the federal withholding, but the other payroll taxes, federal payroll taxes, are what we offset. Does a company using technology transfer product from university qualify? There is what we call a basic research credit, and this is a little bit different than the standard R&D credit. It's for what we call qualified institutions, which is basically universities. They would fall under that. And then it also depends on if it's a private company, it depends on their agreement with the university itself. Stock options. Generally, when they're exercised, is when we look to take the stock options. There's some other rules associated with that as far as qualifying these stock options as actual wages. There's some rules under section 83I of the Internal Revenue Code that direct us in that as to what we can take for stock options.
Jay, if you could read the entire question, so that way it's easier when we're recording this, that somebody knows what the question is.
Okay, yeah. I can do that. Can startups file their own tax credit forms without utilizing CPAs? Yep, yes, they can. The thing is that one thing to caution about is that this is a highly complicated area with a lot of moving parts. There's things that can knock out this credit as far as past years of gross receipts or qualified research expenditures for past years. There's a whole bunch of other stuff. It's a complicated area. Does software such as QuickBooks contain these forms? No, I have never seen anything in QuickBooks that contains either the federal or state forms to be able to do R&D tax credit. If for the year you have revenue, yet your team members did not get paid with salary, can you claim the credit for the year? This, I think, goes to the 1099 question. A lot of these companies are a lot of these startups are set up basically to pay everybody as contractors. And the answer is yes, you can claim it. It's a little bit different than wages. There's 3 types of expenses we look at to calculate the R&D tax credit. There's wages, supplies, and contract research. Contract research is your non-employee payments for people doing those 4-part test things that Janice referred to. There is a little bit of a haircut that the IRS requires that the taxpayer take. It's about a 35% haircut. But yes, we have a lot of companies where everybody's a contractor, and they're getting paid on a 1099, and we can certainly go ahead and pay that way. We can certainly take the credit that way. This is valuable information. I think of several companies I have that qualify that as a startup can use the credit against FICA taxes, make it free money. But how complex is the R&D credit for a small startup to implement? I know a lot of founders will try to do themselves, but maybe they shouldn't. Again, this is a pretty complicated area. I've been doing this off and on now for 20 years, and it was a difficult area for me to learn many years ago. But it's definitely, I would say that you are probably best off having somebody do this for you, because the experts are going to know what documentation you're going to need to back up your credit. And some of these companies are involved in things that some of them are some of these SaaS companies. You know, it's actually, let me back up a bit more. The company tends to look at these things from a business perspective. What's profitable? What am I trying to develop? What do my customers want? And when we're looking at R&D tax credits, it's what were you trying to create? What were the technical challenges you ran into? And companies that do this themselves tend to look at it and say, well, we had 5 people who were on the job, and 3 of them quit, and we had to finish it off with the same budget. Well, that doesn't qualify for the R&D tax credit. The other thing is that a lot of the dry runs that these companies do, where they're trying to develop something and they don't come up with it the first time, and they have the situation where it's really difficult and they have to go back to the drawing board, and this doesn't work and that doesn't work, and it's this nightmare. Those are wonderful for this tax credit. But somebody who's been involved in this quite a while is the person who's got to document it so that it makes sense to the IRS and Franchise Tax Board. How does RDS charge for discovering R&D credits, and when do they get paid? We do this on basically a contingency, and sorry, we do this basically on a contingency, and RDS gets paid as far as the utilization of the credits. So let's say that the company's got tax liability in a year that they're going to actually be able to offset the credits. That's where we get paid. Okay, we meant the team getting paid not by way of contractors. So we would look at the time that the team actually, at the time the salaries are actually paid, because what we look at is for wages is W-2 box 1 wages. That's how we calculate the wages. So if those aren't paid until later, then we're going to want to take the credit later if they're all employees. not by way of contractors. That was the same question, I believe. So are you saying if a company finds out about this tax credit in a year, can they retroactively go back 4 years and claim credits? Good question. It's actually, there's a couple answers to this. One, generally you can go back and amend tax returns 3 years for federal. I believe you can go back 4 years for California. However, it depends. There have been companies where, and you're especially going to run into this in the startup sense. Some of these companies can be in losses for a number of years because they're basically getting venture capital and they don't have any gross receipts. So their tax return is going to show losses year after year. If they're generating credits, depending on the tax structure of the company and so on and so forth, we can actually carry forward those credits to the year that then the company can use it. Tax credits can be carried forward 20 years. So now most of these aren't going to go back 20 years, but I have seen some where we go back 5 years. They've been in losses all these years. We can just carry them forward. That's usually with your C Corps. But anyway, yes, there is a way to go back and do it. Generally 3 years is what we look at. But if the company's in losses, we can grab more. Any other questions?
All right, so these are all the questions. That was really good. Yeah, it's very complex. You want to do it yourself, or you want to spend your time concentrating on your business, right? That's a difference.
Yes.
So spend your time doing what you do best and let the experts do what they do best. Any other questions? If anyone wants to ask questions via audio, just raise your hand in the participants section, and I'll bring you in to ask an audio question instead of typing. So please go ahead and do that. So Janice, by the way, there's more investors on this call than more than other calls we've had. So
Great. Well, the good news is that this is an amazing opportunity for your portfolio companies. So as you roll out, your benefit or your value add to your investments, you might include this as a big value add. It's really huge. We are in the good company of a lot of good investors and VCs that are referring us a lot of their companies, and it's been going really well. It's been a great value, and a lot of CPA firms, a lot of companies, and fractional CFOs that work with multiple companies. We have a lot of companies that are referring, business our direction and into the industry at large, not just us, but it's a big opportunity.
all right, James, go ahead. You had a question.
Yeah, thanks, Janice, and thanks, Jay, for the information. Really very helpful. Quick question. So for any particular year, right? If for this particular year, you only have a portion that you have revenue, and the team didn't, the team is all on equity, based work on equity, didn't get paid, and so in that case, would it be better just don't worry about this year and trying to carry this over another year, or even this year you're trying to, to get paid in certain way to offset this credit, so at least you can gain some benefit, or just trying to do it, use it for later years? What would you suggest?
I would suggest what we want to do is look at everything that's going on within the company and see what we're able to take as far as the expenses. There may be some other expenses for that year, but I would say that the best thing to do would be to look at what the company is doing and see what we might be able to take for that year, and always carry it forward. As far as if they're not getting paid until the next year, we might, like I said, it's W-2 Box 1 wages, so it might be that we don't we don't claim the actual expenses until the next year.
Okay, so when we say the 5 years, that's a 5-year window that we can utilize, right? So that's a 5-year starting when, like say, that is the 5th year, like after you have the revenue, or it's a 5th year after the company incorporated. Like, for example, if you have revenue last year, or if you have revenue this year, you can claim it like 5 years after the year you started having revenue. Is that what it is?
What it is that once you start having revenue, you're pretty much on as far as being able to claim this. So it's not the year you start, it's the year you start having gross receipts, which under that part of the credit is your 1C amount, basically your gross receipts minus returns. So let's say the company starts, and I've seen this before, we just had one recently. Let's say the company starts in 2012, but they're on, but they don't have any gross receipts until 2019. Well, 2019 would be the first year, that would be the year starting in which they could start to, or that would be the start of the 5 years.
So in other words, 2019, they can claim all the way to 2024. So 2024, they can still claim whatever, you know, in 2019.
Yes.
Okay, thanks.
All right, any other questions? Anybody other than James? You can just raise your hand, and then I'll bring you in for an audio question. All right, if you're not going to ask questions, we're going to end this. See, look, Jay's been doing this for 20 years. He still doesn't know what to do. So it's that complex. So
very nuanced. You know, it's the IRS code, and it's very detailed and nuanced and layered. So it's pretty impressive when these guys can work through the process. And it's nice to have it automated, you know, in the process of automation and doing deeper dives and qualifications. It's a great opportunity for companies now.
Yep. Again, like you and I talked, it's double dipping people, but people don't believe it. But so, which is really very interesting.
I know. All the time people say it free money. Are you kidding? Like, yeah,
just like Mike Krebs said, just like Mike Krebs said, it is free money, especially with the, you know, like giving you back your taxes you paid.
It is,
so,
yeah.
All right. So if no one has any more questions, maybe you want to provide the audience with maybe an incentive or some kind of a discount.
Yeah. Let me just show you a couple. Let's see. We have an offer for you, a special offer through Pismo Ventures for a discount with them. And we also have referral programs for those of you out there that have you know, portfolios. We'd be happy to work with you. And so you can just give us a call, use this code. Rochelle, can you put it in the chat, please? That would be really helpful. And they can just copy it from there. And or just call me or email me. Either way, we can, you know, get you, at least tell you what we can do and give you a discount for Pismo, because this is very fun, what you guys have been involved with.
There you go.
Yeah. All right.
Well, thank you very much. That was very, very valuable, very informative. Like I said, every time I learn something. If we could learn one thing from each one of these webinars, it's quite valuable. So, Janice, thank you very much. Jay, much appreciated. Rochelle, thanks for being on the call. Everyone, thank you for being here. Again, join us tomorrow for the final round of the third round of the competition. It's at noon tomorrow from 12 to 3. It'll probably be 12 till about 2:30 in general. Thanks for all the judges, investors that are on the call today. Because Janice said most investors don't even know about that. So, and it's true. I learned about it just about a year ago, and it's been very valuable for my knowledge as well to really pass it on to the portfolio companies. Thanks again, Janice.
Thank you.
Talk to you all soon.
Thank you. Take care.
Bye-bye. Have a great day. Oh, we
Bye.
do have one question. Oh,
Okay. Yeah. Yep.
thank you. It's only a thank you. All right. Take care, you guys.
You're
Bye-bye.
welcome. Bye. Thank you.
Bye.